Hello, good evening, everyone. Welcome to all of you for today's session. Students, just let me know whether you people can hear me well. Can you hear me?
Yes.
Good. Now, so students, we are doing investment appraisal. Let me open the Excel sheet in front of you. Just a minute, please. Yes. So in the last class, we have covered yes. So we have covered net present value. We have covered net present value, and today itself, we will continue with NPV and then IRR, then NOT, then perpetuity. Okay. Students, when the NPV is calculated, here is the layout in front of you. Sales minus incremental cost. Different costs are there. That is, for example, a variable cost, incremental fixed cost. Then there are taxable cash flows, tax payments on the taxable cash flows, initial investment, scrap value, and we calculate net cash flows. Then discounted, and then NPV is calculated. Students, there are some adjustments in the NPV, which is the topic basically for today. Adjustment of inflation, adjustment of taxation, and adjustment of working capital. So three adjustments we will be talking about today. Come here. Yes. So adjustment to NPV. Adjustments to NPV, net present value, pro forma. The first adjustment is that of inflation. Yes. The first adjustment is that of inflation. What is inflation? Students, inflation is basically increase in general price level. That is called inflation. Increase in general price level, that is called, yes. Now, inflation. When the prices are increasing. So inflation is of two types. One is called specific inflation. The other is called general inflation. Specific inflation is basically price increase in the specific item price. Specific items, the price increase in the pricing of a specific item, that is called a specific inflation. For example, we say wheat prices or rice price or petrol price, how much increase? Okay, this percent increase. So that will be the inflation of wheat. That will be the inflation of rice and the petrol. Then is the general inflation. General inflation is overall or generic increase, overall average inflation on basic necessities of life. Average inflation, basically it is calculated by the central bank normally. So students, next, in the NPV pro forma, impact on cost of capital, impact of inflation on cost of capital or discount rate. Cost of capital or discount rate can be of two types. One is called real cost of capital. The other is called money cost of capital. Real cost of capital and the other is called money cost of capital. So real cost of capital is that cost of capital which is without the impact of inflation. Without the impact of inflation, in which inflation has not been considered. And money cost of capital, it is with the impact of inflation, which includes inflation, in other words. Which includes inflation, basically. Which includes inflation. Now, so students, what is the link between the both? What is the link between the both? There is a Fisher's formula which explains the linkage between the money cost of capital and real. 1 plus money cost of capital, 1 plus money cost of capital, that is equal to 1 plus real cost of capital into 1 plus general inflation. 1 plus general inflation. Yes. So this is the formula which actually discusses the relationship between the both. Now, so students, for example, real cost of capital, that is 9%. General inflation in the economy, for example, that is 3%. So what will be the money cost of capital? Give me answer. Be quick. Apply this formula. Give me answer. I need answer for money cost of capital. Be quick. Be quick, please. Give me answer. Okay, no worries. No worries. This is the formula which is to be applied, given above. This is the formula to be applied. 1.12. Really? 0.12. Answer should be 0.12. How? How? You see here, 1 plus money cost of capital is equal to 1 plus real cost of capital into 1 plus general inflation. Here it is. Yes. It is basically what happened. Just a minute, please. Excel is not responding. Just a minute, please. Just a minute, please. What happened? Just a minute. I think I need to end Excel immediately. Excel. Yes. Just has gone. Now it will be good. Yes. Okay, good. So it is basically 1.09 into 1.03. Why it is giving this answer? Yes. Yes, here is the answer, please. So 1.09 into 1.03. Here. So money cost of capital, that is equal to this minus 1. So hence we can do it in the percentage. 12.3%. 12.3%. The next point is, student, it's very easy to calculate. The next is, so cost of capital, impact of inflation on cost of capital. So impact on cash flows. Impact on cash flows. What is the impact? One is called real cash flows, or current cash flows, or cash flow. Yes. The second is called money cash flows, money or nominal cash flows. Money or nominal cash flows. In the real cash flow, again, cash flow without inflation. In today's price, they are also called in today's price term. Nominal money cash flows. Cash flows with inflation, which are called inflated one. They're called money cash flows or nominal cash flows. Next, so students, approaches to calculate NPV. Approaches to calculate NPV. There are two approaches. Focus, this is very important. Tested in the past exam paper multiple times. Tested in the past exam paper multiple times, I'm telling you. Yes, two approaches. One is called money approach, very easy. Money approach. Money approach is very easy, or nominal approach. That inflate all cash flows with their specific inflation, and then get net cash flows. Second, discount net cash flows using money or nominal cost of capital. Very easy to get NPV. Straightforward method. Straightforward method. Next, the second approach is real approach. Real method or real approach to calculate NPV. Students, now there is some complexity. There may be the two cases. Case one, specific inflation and general inflation are same. Case one, calculate net real cash flows and discount them with real cost of capital to get NPV. This is the case one. Real net means you need not to inflate anything. Now, the next point is the second case, case two. Specific inflation are different. Now, so what to do in this case when specific inflations are different? In this case, we need to inflate all cash flows using specific inflation, calculate net pre-tax cash flows calculate net pre-tax cash flows. And then for money cash flows calculated above. You will understand it better when I will be solving it. Just note down right now. To calculate, yes, money cash flows calculated above. And the third is discount money cash flows using general inflation and get real cash flows. Add or deduct all remaining adjustments of NPV, pro forma, right? All remaining adjustments to get net real cash flows. Now, discount the cash flows to get NPV. Note it down, I'll explain with example. Right now, I'm explaining the steps only. I'm writing the steps only. Note it down, please. Yes, please. Have you noted it down, all of you? Okay, good. Just give me 1 minute. Let me try to send you exam kit here. Just 1 minute, please. So that we can solve some of the question now. I'm sending it in the chat box, please. It's uploading here, and download it, please, everyone. Yes, so this is the exam kit, Kaplan, with you people. So we need to solve some of the questions on the topics which we have covered so far. Section A, B, C type question. So investment appraisal. Let us start doing some questions on the section A type first. Page number is 20. Right. Let me do BPP kit with you. Keep it with you. Let me send the BPP kit to you as well. Normally, I do this Kaplan in the crash course as a revision. So I'll be sending you BPP as well. Just a minute. Yeah. So we will be doing BPP here. This will be done in the crash course. Oh, size is big. The file size is coming. Meanwhile, it will meanwhile we can start solving question here. It is being uploaded from my side. Yes. So yes, financial management, working capital, investment appraisal. A type question, B type, and C type. Okay, good. And the page number is okay. Okay, students, here we are. Here we are. The question is in front of you people. What is the return on capital employed? What is it? ARR for the lorry using the average investment method. Nearest percentage. You see? Yes. Whole number. Remember that. Nearest whole number. No decimal point. No, there will be nothing after the decimal point. Remember. NW company is considering investing 46,000 in a new delivery lorry that will last for 4 years. After which time it will be sold for $7,000. Yes. It will be sold for 7,000. Now, students, the point is depreciation charge straight line basis. Forecast operating or loss is as follows. Students, I request you people, I have just sent to you exam kit in the chat box. Download it. Be quick. Download. Exam kit has just been sent to you. People in the chat box, just download, please. And if you have done it, do let me know that it is done. Good. Other people as well, be quick, please. Now, so students, this is profit. First of, remember these questions, which are objective test questions, we need to solve on calculator. I would request you people, it is the, yeah. Tell me, average annual profit, it is profit. Tell me, average annual profit. Add these four, divided by 4. Give me answer. Be quick. Add these 4, divide by 4. Give me answer. Give me answer, please. Only one person has sent me the answers. Add 4 on the calculator. Divide by 4 number of years. Average annual profit. 13,000. Thank you. Average investment. What is it? Initial investment is 46,000. Scrap value is 7,000. 46,000 plus 7,000 divided by 2. Give me answer. Add both, divide by 2. Add both, divided by 2. 26,500. Good. Right. Now, next. The next point is ARR, ROS. 13,000 divided by this. Give me answer. 13,000 divided by 26,500. What is the answer? You know, I'm not doing it deliberately in the Excel, because in the exam you have to solve it by calculator, OTQ. %. Complete. 49%. Nearest percentage. 49% is the answer. This 91 question number. Now the second part is tough. Second part is tough. Assume operating cash flow arise. What is the payback period for it? Now student, just see here. Question number 92. I was waiting for that question. They say profits are profits. Year 1, 2, 3, and 4. Profits are 16,500, 23,500, and negative 1500. Students, for payback period, the next question is on the payback period method. We need to calculate payback of the, yes. We need to calculate that. Now, in order to calculate payback, we need cash flows. We have profits. We have profits. We need cash flows. Now, my question from you is how to calculate cash flows. I have told you in the last class how to calculate. I told you a formula, if you remember, that in the cash flows, if we deduct non-cash expense, what we get? We get profits. So we need cash flows now. So profit less depreciation. So what is the depreciation? Depreciation is straight line basis. Now I want you that you will be giving me year zero. Initial investment is 46,000, right? You will be giving me annual depreciation charge. Annual depreciation charge for this machine. What that will be? $9,750. How to calculate that? It is annual depreciation charge. You see here. You will calculate using calculator, I'm telling you. 46,000 is the total cost. Scrap value is 7,000. Straight line basis, we said, divided by number of years. Straight line basis of depreciation is calculated like this, 9,750. Now, you see here. So, if we come here, depreciation. Depreciation is 9,700. So, you see here, we need cash flows. Profit minus depreciation. Profits minus depreciation. Just a minute. Sorry, my mistake. What is my mistake? Tell me. It is plus. Profits plus depreciation. You see, it is minus on the other side. It will be added here. it will be added this side, right? Profits plus I didn't get your question, Keshav. You asked a question, but I didn't understand. Can you elaborate? What is that? Oh, yeah. Oh, sorry. 9750. You are right. 9750. Okay. Right. Okay. So here we go. Now, so students, these are the cash flows. Now we can calculate payback, cumulative cash flow column. Cumulative cash flow. This plus this plus, yes, sorry, 1 year. Now here 33,000. We have 19. We need this. So 1 year. And how many months? 19,750 divided by 33,250. This last lecture, it is related to the last lecture, into 12. Into 12. 12 months in a year. So it is 1 year and 7 months. 1 year and 7 months. One year and 7 months. Which two are the following are the benefits of payback? Tell me. A, B, C, D. Which two? I need more answers. One person responded. I need answers from more. Yes, please. I need more answers. This is not fair. I need answer. I mean, it will not be one-sided dose. You at least you should guess. Maximum it will be wrong. Tell me. Otherwise, I will call your names and then ask the question. It considers the whole life of project. Yes, it considers. We take the whole project cash profits and divide them. Now, cash flow based, no, wrong. ROS is the only method which is profits based. Wrong. It is a percentage which is meaningful to non-finance. Exactly. Easy to understand. It is impacted by. Wrong. So answer is A and C. Which two of the following are benefits? So A and C. Is it clear? Tell me. Now, so some questions which actually yes, which we have done already related to that. 97. So now, which of the following is a drawback of payback period method of investment appraisal? Which of the following is a drawback? No. C, exactly. C. 2 is not related to it. We said it does not consider time value of money. Then it is a drawback. They say it considers. So B cannot be. B cannot be. Payback period does not consider time value of money. It is a drawback. But they say it considers. So B cannot be. Be careful. C is the answer. Yeah. No worries. This is how to practice. I appreciate you people are contributing. I don't want correct answer from you. I want your answer, whether it is incorrect or correct. We are here to learn by mistakes. Now, a project has average estimated cash flow of 3,000 per year with an initial investment of 9,000. Average cash flow per year. It is past exam question, by the way. Depreciation is straight line with no residual value, means zero residual value. The project has a 5-year lifespan. 5-year lifespan. Target ROS is 15%. Target payback is this. ROS is based on initial investment. Now, this is important to understand. I will explain, don't you worry. Under which capital investment appraisal it should be? Now, you see here. 1, 2, 3, 4, and 5. Yes. They say the cash flows. Investment is negative 9,000, right? So 300,000. Payback is very easy to calculate, by the way. What is the payback period of the project? Tell me. 3,000 annual cash flow. Initial investment 9. So 3 years is the payback. So payback period, very easy. So we can calculate cumulative cash flow. Remember, for payback, we need cash flows, already cash flows given. Now, you see here. Oh my God, where it has gone. Here it is. Yes. This so 3 years. Payback period is of the project is 3 years. Payback of project is 3 years. Required payback is how much? 2.5 years. So under payback, it should not be accepted. No. So 2 cannot be. 2 cannot be. So 2 cannot be. So these two are rule out. No, either answer is A or D. Let us calculate rows. Let us calculate rows. Student, this year required payback is 2.5 years. Its payback is greater. So we cannot accept the project on the payback basis. These are the cash flows. Now, students, what we need to calculate rows? We need profits. I'm sorry. So depreciation charge. Now give me annual depreciation charge. Be quick. Tell me. Annual depreciation charge. Give me, please. Okay, 1800. How many of you have been able to calculate the straight line basis? Depreciation. So 9,000 divided by 5 because scrap value is 0. Now we need profit. Students, we need profit. What is the profit? We need profit. So profits is equal to cash flow minus depreciation. This minus profits. So students, average annual profit is same, 1200. Average annual profit, 1200. They say use initial investment to calculate ROE. They said that, not average investment. So we will calculate the same. Initial investment is 9,000. So ROE 1200 divided by 9,000. It is 13.33%. It is less than, so neither less than the target, more than the target. So then neither. D is the answer. Is it clear? To everyone, is it clear? Good. Next. Students, one decimal place. This question you will do yourself. 99. Question 99 you will try yourself at home. Okay, let us do it. 99. It seems to be tough. Considering a 40-year project, initial investment 50,000. Then they say zero scrap value. Payback period 20 years. Payback period. They say 40-year life. 40 years. Consistent cash flow each year. My question from you is, I want annual cash. What will be the annual cash flow? Give me. Think and tell me. It is a matter of your common sense. It is a test of your intelligence, basic. I received one answer. More answers, please. Now, is it tough? I'm not getting any response from you guys. This is not fair. Tell me, please. What is the annual cash flow? Initial investment is this. Payback period is this. Annual cash flow is same. Consistent. It means annual cash flow. Just think and see here. 50,000 is, they will get it in equal installment in 20 years. Payback period is 20 years. They will get investment back in 20 years with consistent cash flow. So what is the answer? Annual cash flow. Is that clear? Is that clear to everyone? Now, next. The next is ROS, average investment method. What is the annual profit? Average, because annual profit is same, average annual profit. 40-year life, zero scrap value. Scrap value zero. What is the annual depreciation charge? What is annual depreciation charge? 50,000 divided by total life is 40 years. Because zero scrap value, annual depreciation charge is here. So annual profit, cash flow minus depreciation. Cash flow minus depreciation. Here we go. Cash flow, annual cash flow. Yes. Minus depreciation. Annual profit. Average investment. What is your initial investment? Plus scrap value 0. Divided by 2. Divided by, because they say on average investment to 1 decimal place. ROS. Average annual profit. It is 5%. 5%. Is it clear, students? Is it clear? Now, next point. So we have to do a past exam question, which is on inflation, basically. Okay. Yes. The question is on inflation. Section C type question it is. Yes, here it is. Pink company. This is the question. March, June 19. Scenario-based question it is. Pink company. Calculate the nominal NPV of the project, 8 marks. Calculate the real NPV of the project and comment on their findings, 4 marks. Please read the scenario 1. Students, let us take a 5 minute, 7 minutes break. 7 minutes break. We'll be back and then we will solve this. Meanwhile, you can go through it. Okay, right? Then I will solve it. Just 7 minutes break. Yes, students. Have you gone through the scenario? Have you gone through the pink company scenario? Please let me know. Can you hear me? Students, can you hear me? So have you gone through the question? I asked you. So the question is pink company. Okay, so Pink Company is a large listed company listed on a stock market, stock exchange. In recent years, the board of Pink's company has been criticized for weak corporate governance, and two of the company's non-executive directors have just resigned. A recent story in the financial media has criticized the performance of Pink and claims that company is failing to satisfy the objectives of its key stakeholders. Now, Pink is appraising an investment project which it hopes will boost its performance. The project will cost $20 million, right? Now, payable in full at the start of the first year of operation. The project life is expected to be 4 years. Okay. So 20 million initial investment. So here are, student, first of all, we will be doing here below working sales. Yes. Working year 1, 2, 3, and 4. Units per year. Units sale per year. They say 300,000 in the first year, 410,000 in the second year, 525,000 in the third year, and 220,000 in the fourth year. Yes. Next. Next is selling price. So the working one is for sale. Sales. Selling price per unit. 125, 125, 130, 140, and 120. This is in the, they say selling price and cost are in current price terms. And selling price specific inflation is 5% per year. 5% per year. So inflated selling price. Focus, everyone. They say it is 5% per year. Yes. This into 1.05 raised to power number of years. For how many years it has to be inflated? This 5% inflation every year. Yes. Just check it. Check this formula. Inflated Is it clear? I hope. Now, simply drag it. Selling price for every year. Is it clear? Now, next. The next point is working two. Variable cost. They said it is 71, by the way. 71 each year. Okay. Inflated. Sorry, I missed one thing. Just a minute. Let me complete the sales first. Sales. This selling price into units sold. Selling price into units sold for the year. Here we go. Here we go. Now, next. Unit sale into inflated selling price. Now, so simply you can drag it. Simple as that. This is sale. Variable cost, inflated variable cost. Variable cost inflation is 3.5% per year. This into 1.035 raised to power. Same approach as that of sales. Here we go. And simple as that. Yes. So working to variable cost. So variable cost, total cost. Per unit cost multiplied by number of units. Here we go. Students, next is fixed cost. And fixed cost is 3,000 here, working three. 3,000, 3-digit round off. So it is 3 million basically. 3,100, 3,200, 3,000. So inflated fixed cost 6%. That's what we are doing, by the way. We are doing the first part, nominal, where we have to inflate all cash flows to get nominal cash flows first. Now, into 1.06 raised to power. This is the fixed cost. Next, very easy. Is it clear to everyone how it is done? Student, there is one adjustment in the question. For that purpose, we need to discuss another topic. I just have seen one adjustment. So we will leave it here, okay? We will leave it here. We will come to the studies where we are doing. So inflation adjustment we have studied, but it's practice we are doing, okay? But we need to discuss one small topic, adjustment of taxation. Let me complete it. Then let me discuss this small topic. Then I'll come back to the question again. Okay, adjustment of taxation, because its adjustment is present in the question. Taxation adjustment is on the cost of capital. Always use post-tax cost of capital unless stated otherwise. Post-tax cost of capital. So post-tax cost of capital is equal to pre-tax cost of capital into 1 minus tax rate. 1 minus tax rate. Students, post-tax, for example, pre-tax cost of capital is 12%. Tax rate is 25%. What is the post-tax cost of capital? Pre-tax cost of capital into 1 minus this. 1 minus this. Now, next. Students, cash flows. Impact on cash flows. Two impacts. Tax payment on taxable cash flows. And second is tax saving on capital allowance. Now, sales minus cost. Sales minus cost. These are the taxable cash flows. And you have to pay tax, for example, 30% on it. That's its tax payment. Very easy. It can be, tax can be in the same year or in the next year, which is called arrears. Follow whatever given in scenario. Means for year 1, tax has to be paid in year 2. For year 2, has to be paid in year 3, and so on. Now, tax saving on capital allowance. Yeah. For example, initial investment in a project, that is 2,000. Scrap value is 200. Life of the project is 4 years. Tax rate 30% in same year. And capital allowance can be claimed at 25%, reducing balance basis. Now, now you see here, what we need to calculate. We need this. We need this. So written down value. First of all, we need to calculate capital allowance by this method every year, which we have studied in F3, financial accounting paper. But okay, don't worry if you have forgotten. So written down value at the start of year 1. This. Capital allowance. This into 25%, reducing balance basis. Written down value, this was the initial value, this capital allowance charge. So written down value at the start of year 2. Student, this you must be able to calculate manually on a calculator using calculator as well. So conceptually it should be clear, because in the section A and B, some question can be tested on capital allowance, then you have to calculate on a paper. There will not be any Excel sheet. This into 25%. Return on value, this minus this. Now, next, equal to this into 25%. And in the final year, this minus scrap value. Student, capital allowance calculation is clear. Yes, please. Everyone, is it clear? Right. Now, tax saving, we need to calculate tax saving on capital allowance. How to calculate that? Very easy. They said tax is in the same year. So same year. This into 30% tax rate. Capital allowance into tax rate. Simple is that, because tax is in the same year. If tax is in the area, then it would have been starting from here to here. If they, for example, if they say it is in the area, then it would have been like this. Would have been like this. Right now it is in the same year. So this is how adjustment is done. This is the cash inflow, tax saved. It is a cash inflow. Now, next. So come back to the question again. In the question, there is an adjustment here. Tax rate is this. Tax liability settled in the same year. Tax capital allowance on the initial investment on 25% reducing balance basis. And the investment project is expected to have zero value at the end. So working for will be tax saving on capital allowance. Yes. Students, 4 years. Yes. This is year 1. They say it is how much? 20 million. 20 million. Written down value. And capital allowance. Then tax saving on capital allowance. So they say that it is 25%. This into 25%. Same approach. Scrap value is 0. So the full will be charged here. Tax saving on capital allowance, 26%. This into 26%. Here we go. Done. So A part is almost done. Nominal after tax cost of capital is given. 12%. So students, come back. So A part, first part. The first part is nominal NPV of Pink Company. Year 0, 1, 2, 3, and 4. Sales. Sales. Less variable cost. Negative sign. Negative sign I added by myself. Like this. Simply, it is here. Less fixed cost. Negative sign. Here we are. Now, net taxable cash flows. Yes. Simple as that. Tax payment, 26%. So it is in the same year, negative 0.26% into tax payment in the same year, students, here is the tax payment. Here we are. Now, initial investment, 20 million. Negative. Tax saving on capital allowance. Yes. Anything left? Nothing. Everything is done. Net cash flow. Sum. So present value at the rate of 12%. Nominal method. Nominal cost of capital. 9% equal to this into 1.12 raised to power minus this. NPV. Sum. Here we are. NPV. The first part, 8 marks is it. Any point you want me to re-explain, any adjustment, I am here. Now, net cash flows to end. Net cash flows to end. Okay, present value. I have applied this formula. Present value is equal to future value into 1 plus r raised to power minus n. You see here, this is the present value formula. Net cash flows. Present value minus n. R is the rate of return. This is the future value. Future value. No, sorry, my mistake. I have written 9%. Oh, my mistake. Why 9%? I have applied 12%. Right. I'm sorry. Why 9% I have written? It is 12%. I'm sorry. 12%. Typo. 9% is typo. Okay, now, students, second part, calculate the real NPV. Real NPV. Now, second part. You see here, second part. Real NPV we need to calculate. So year 1, 0, 1, 2, 3, and 4. Taxable cash flows. Taxable nominal cash flows. Here we are. These are the nominal cash flows. Right? These are the nominal cash flows. And students, the next point is, I told you, now real method. We have to discount them to the, first of all, real cash flows. So present value, yes, taxable real cash flows. How to calculate? Discounting all them using general inflation rate. Using general inflation rate. What is the general rate? 3.7%. This into 1.037 raised to power minus. This will become a real cash flow. Taxable real cash flow. Next, tax payment, remaining adjustment, 26%. 26% into now real cash flows we are using. Okay. And the remaining investments are same. Initial investment, that is 20 million. And then is tax saving on capital allowance. Same. Net cash flows. Any other adjustment? Yes. Net cash flows. Sum from here to here. So we converted all nominal cash flows into real cash flows first. How? We discounted them using general inflation rate. Then we did all necessary adjustments, and now present value at real cost of capital, which is 8%. This into 1.08 raised to power minus this. This question was not under plan today in the as per lecture plan, but I thought because it is getting linked, let us do it immediately, instantly. NPV sum from here to here. I repeat, since cash flows have different inflations, we calculated taxable nominal cash flows through inflation. The same we did here. Then we discounted them using general inflation rate, converted them to real, then paid tax and remaining adjustment. And NPV is here. NPV is different here. Here NPV is higher. You see? Or here it is higher. Let me, yes, 33 million. And here it is 50 million. Okay. Note it down, please, everyone. If there is any question, please ask me before we proceed. Okay, students, now comment. We need to comment on that. Just give me 1 minute. I'm checking one error. I think there is one error. Just 1 minute, please. Okay. Just a minute, please. There is an issue in the net cash flows, basically. Yes, I will be providing it in the class WhatsApp group. Okay? I'll be providing it in the class WhatsApp group. It has been formed. It has been formed already. Okay, right. Just a minute. Students, there is some error in the nominal cash. Real cash flow is answer is okay. The problem is coming in the nominal. Okay. Fixed cost net. And the tax is here. 26%. Okay. Anyways, I didn't find any error, but answer there is a problem. I don't know why it is there. You can check it yourself from the kit. Because the calculation is the same. Almost. So, students, the next point is, the next topic we have to discuss is, that is, yes. But today, NPV adjustment is done, IRR and NOT and perpetuity. Okay. So NOT perpetuity, I think, will not be possible today. Internal rate of return, let us discuss. Internal rate of return. What is internal rate of return? Yes. So the internal rate of return is basically effective annual return from the project considering time value of money. You may have studied IRR definition. It is the, or there is another definition. It is the rate at which NPV of the project becomes zero. This is the normally definition which is studied, the second one. So, when the return is deducted from the project cash flows, when return is deducted from the project cash flows, what remains? Initial investment, which has to be repaid. So IRR, the formula is lower rate of basically two NPVs we need to calculate. Student, in section A and B questions, you need to calculate on the calculator. In section C, you simply can apply formula of IRR. So IRR is equal to lower rate of return plus, I'm sorry, you might be getting a bit confused. Clarity is you get when you do some questions. So please, NPV at lower rate. Yes, NPV at lower rate. Let me go to the notes. Yes. IRR. The formula is not mentioned here. Okay, NPV at lower rate. Just a minute, please. Let me connect my iPad to explain it better, because I need to draw some graphs as well to explain it. Just a minute, it is getting connected, please. Yes, students, IRR, the formula, please note down. Lower rate of return plus NPV at lower rate over NPV at lower rate minus NPV at a higher rate plus into higher rate minus lower rate. Note it down. Basically, what we need NPV of project at two different discount rates. So hence higher rate and lower rate. In that context, it is being used. Now, next. Students, basically, how it is calculated. Now, try to understand. For example, case 1, NPV at both discount rates are positive. You see, this is discount rate. This is NPV. At one rate, NPV is here. For example, lower rate. At higher rate, for example, it is here. So it is like this. This is where NPV is 0. This is IRR. Now, case 2. Is it clear, student? This is NPV at lower rate. It is NPV at higher rate. Is it clear? This is clear? Tell me, how IRR will be there? IRR is the rate at which NPV will become 0. Is it clear? Now, second, case 2. NPVs at both discount rates is negative. Now, this is how it happens. NPV, discount rate. So you see here, negative NPV at lower rate. Negative NPV at higher rate. This is IRR. Now, case 3. NPV at one rate is positive and the other is negative. You see here. This is the interesting development. NPV and discount rate. So NPV at lower rate is positive. At a higher rate, it is negative. Yes, this is here. This is IRR. Now, students, you see here in all three cases, now, one more thing. This process is called interpolation. What is interpolation? Finding a point among or between 2 points. We have done the same here in this case. We have found a point between 2 points. Interpolation. Now, next. In the case 1 and 2, in both cases, what have we found a point beyond 2 points? This is called extrapolation. Finding a point beyond 2 points. It is called extrapolation. Now, let us proceed further. So students, in this way, IRR, for example, a project cash flows are as follows. Investment is, for example, in year 0, investment is negative 1,000 million, 300, 450, 470, and 420. Cost of capital is 10%. What is NPV? So discount rate at the rate of 10%. We can see it from the discount table. It will be available in the exam platform. 0.909, 0.826, 0.751, 0.683. This is the discount rate. Multiply and give me NPV at 10%. Be quick, everyone. Solve it and give me answer. I'm waiting for your answers. Please be quick. Yes, 284.23. I have received 2 answers. Other people should also verify whether it's the same answer or not. So now NPV at now discount factor at, let us use another discount factor, 12% or 15%. Okay. So discount factor we can get from the notes which I have given to you people, that they are part of discount table is given in that, I think, or not? It should be there. Yes, it is there. Page number 9 has discount table of the notes. So discount factor at 15%. Year 1, then is 0.870, then is year 2, 0.756, 0.658, 0.572. So we will be multiplying cash flows with it. And getting NPV, present value and NPV. Give me answer. Be quick. NPV at 15%. Yes, please. 15% NPV.
Okay, one answer I have received. More answers, please. $150.7. So 2% verified at 15%. So we have already obtained two NPVs. NPV at 10%, 284.23. NPV at 15%, 150.7. So IRR, applying the same formula, the formula is, you should memorize, lower rate, NPV at lower rate over NPV at lower rate plus NPV at higher rate into higher rate minus lower rate. This is what we need to apply. So IRR, 10% lower rate plus NPV at lower rate, 284.23. Into 15% minus 10%. Now, give me answer, please. Solve it and give me answer. No, 13% it cannot be. It cannot be 13%. Students, I initially, just a minute, please. The formula, there is a mistake here. So initially, I was writing that was correct. Here is negative. This formula will be available in the exam formula sheet. In that exam formula sheet, it will be available. I just checked from the exam formula sheet of examiner. Minus. Yes. So if you forget it, exam formula sheet, it will be available. Minus. So now tell me. %. Yes, this is the answer. Correct answer. 20%. Exactly. So IRR is calculated like this. So students, yes. So correct this formula. There is negative in the formula. Yes. So IRR is done. Students, IRR through exam in the section C, how it is to calculate? How to calculate in the section C? Section B we have learned, A and B we have learned. Very easy to calculate in the section C. Just see here. For example, it is a project negative 2,000, 525, 630, 450, and 770. Make it 650. Yeah, how to calculate IRR? In the section C, IRR, select all cash flows and enter. Life is easy. In the section C. And what is the rule? The rule is that if IRR of a project is greater than cost of capital, we say accept the project. Why? Because IRR is returned from the project. return is greater than cost. So accept. Otherwise, if it is less, reject the project. Otherwise, reject the project. Is it clear? Okay, so students, we are going to end class here because we have done some practice questions today. So, which were not in the original plan, but it's good. We have touched the past paper questions. In the next class, when we'll join, so we will be continuing from here. IRR, I will wind up. NOT, it will be 30 minutes job. And then risk and uncertainty and practice questions. In the next class, we will have more practice questions along with risk and uncertainty. That is on 24 January. But do revise this well. And from the exam kit, I would suggest to you that try to solve some of the objective test questions from this section. Let me show you. Try to solve some of the question by yourself. I will be solving, of course. Yes. So section investment appraisal, decisions. Yes. Allowing for inflation and taxation. We have done this. Try to do this OTQ bank. This one. Okay. 9 questions there are. 9 questions there are. Section B type question I'll be doing with yourself, myself. This one, try this, and some question from this area as well, which I have not done. I have done question with you from this section area, these areas. So, okay. So thank you. We will be meeting in the next class. So WhatsApp group, if you have joined, I will be sharing this working over there. Thank you. God bless you. Take care. Goodbye. Goodbye.